but you shouldn't listen to anything that Jerome Powell or any of the governors have to say at all. It will provide you absolutely no value, no alpha value in predicting what's likely to transpire. The Fed, and this last 3 months is 3 or 4 months is such a good indication of that, which is the Fed responds to the data. The Fed doesn't respond to their predictions. The Fed doesn't respond to their guesses. The Fed responds to the data. And so if you want to get a lead on the Fed, stop listening to what they have to say because they have no idea. They have no predictive ability. The Fed has no predictive ability. And so if you want to understand what they're going to do, understand what is going on with the data that they use to respond to, and even better, predict the data that they're going to use to respond. And so when you're thinking about, how do you interpret what's going on, I think it's important to connect what is most likely to happen with the data that they're responsive to. And so as an example, if we went back in, January, I sent out an outlook in the beginning of January, and I basically said, it looks like the macroeconomy is likely to be stronger for longer than what's expected. And that's because of combination of different things, in part because stocks have gone up a fair amount, which was a positive stimulative effect of the economy, and interest rates had come down, which essentially was a big financial market easing, which would create a reacceleration or continued strength in the economy and a continued elevation of inflation pressures. And so that gives you a good example. So whatever, the Fed said 3, the market said 6 to 7. And when you looked at what was likely to drive the macroeconomic outcomes in the next 3 or 6 months, it basically looked like 0 is the right answer. And so that's alpha. That's where the alpha opportunity is understanding how the data is likely to transpire, not listening to what they have to say. Now, today, conditions are quite a bit different in the sense of, essentially the market pricing. You always have to start with the market pricing. Whenever you're betting on markets, start with the market pricing, start with what's priced in, and predict what's likely to transpire relative to what's priced in. On the short rate market, look, what's priced in is basically, one-ish cuts over the course of 2024. Are they, could it be 0? Could it be 2? Who knows? It's not 6 or 7. The easy money's been made. I think the mispricing in the short rate market is not that interesting at this point. On the margin, I think it's probably going to be tighter than what's priced, but it's a pretty low alpha trade at this point. Whereas when you look at the overall environment, what you see is basically stocks are priced in a way that they're reflecting an expectation of continued very strong growth in an environment where we've had a meaningful interest rate rise over the course of the last 3 or 6 months. And this is one of the interesting things that, which would typically indicate that we're likely to see a slowing, but expectations are for growth to be as strong as it's been, in the last couple of years, despite the fact we've basically had a market-based tightening over the course of the last 3 or 4 months. And so those are the sorts of dynamics, right? You want to think about, okay, well, what are the Fed is going to decide based upon certain data. What drives that data? What is priced in related to that data? And where's their gap between those two things? So there's not much of a gap in the short rate market, but there's actually a fair amount of gap in the equity market right now. And we're seeing basically that dynamic play out where, equities can't, bond yields are high enough right now where it seems like every day we come in and equities try their darndest to get a bid and they just can't quite get a bid. And that's because expectations of earnings growth are very high and because we're experiencing a monetary tightening ahead. And so that's really the more interesting area of the market is the long end of the bond market and the equity market, much more so than what's going on with short rates.